Welcome to the Smart Legacy Podcast, your resource for protecting assets and securing your future. Hosted by Stockton and Cant, join us as we cover essential estate planning and elder law topics, such as wills, trusts, and Medicaid planning. Stockton and Cant, your trusted attorney advisors in safeguarding what matters most. All right, thank you for joining us today, and welcome back to another episode of the Smart Legacy Podcast. I'm Glenn Stockton, managing attorney for the law firm of Stockton and Cant. We're an estate planning and elder law firm here in the Kansas City area, located over in Corporate Woods. I have the pleasure today, I have in studio with me Carlie Bittel. Carlie is a CPA. She's actually my CPA, and she is fantastic. And we're going to be talking taxes today. So Carlie, if you would, just kind of introduce yourself to our listeners.
Glenn, thank you so much for having me. Carlie Bittel, I am the founder, owner of Bittel Books and Taxes. We are a small but mighty group of 14 of us. Now we are located nationally all over the United States, but we work primarily with small businesses, small business owners, and individuals looking to really dig into tax planning and optimize their tax situation. And we offer bookkeeping services as well.
You know, Carlie, one of the things that, and I talk to clients about this, and I refer a lot of my clients your way, and I talk to clients that, in my view, I see taxes two ways. I see, the microscope view where we're looking, how do we minimize the impact of taxes? We're looking at, are we getting all our deductions? Are we taking all our credits? Should we be deferring income? And all these microscope kind of views. But I also look at taxes that we should be looking at it through the telescope, long-range planning. And my experience has been that very few CPAs, unless maybe pushed, they're not really taking that long-term look. There's not necessarily tax strategy. And one of the things that has always stood out to me is that you are really, really good at going between and making sure we're looking through both lenses. And so that tax strategy planning is something I think comes very naturally to you, and you've got a lot of expertise in it. So I'm just excited to have you as the tax preparer here on the show today.
Well, thank you. And so tax preparation, of course, is the compliance piece of what we do. But where I have fun and start to get excited is where can we max out deductions and do tax planning for long-term and short-term strategy.
So tell me, from your perspective, why is an attorney-CPA collaboration so important to clients?
That's a great question. It is so important. We cannot understate the value of having a good team. So certainly I have strengths. There are some things that I don't know. You have strengths in what you do. Bring our strengths together so that we can serve a client holistically. And certainly not just us, but have a good insurance person, have a good team member that really can help a client or set of clients find the best strategy for them overall in their situation.
I tell clients, this is a team sport. I'm not a tax preparer, but I want to make sure that, your CPA or whoever's preparing taxes and your estate planner, we're rowing for the same shoreline here, and we're on the same page. All right, so I want to set the stage for listeners today. I've previously broken down a little bit the 2025 tax changes that came in with the new tax bill that was signed in on July 4th, the One Big Beautiful Bill Act, I guess, OBA as it's referred to. So really what I want to focus today and really get the CPA perspective on is what's in store for us in 2026 and beyond. So from your vantage point, what are kind of the top 3 to 5 changes that people are going to see due to this new tax bill?
Yes, and the bill was a very interesting study, so we really had to go piece by piece and spend some time learning so that we could then pass along that knowledge to clients and apply what we could in their situations. So a lot of very cool and unique provisions kick in 2025. We're currently doing planning for that, but we have to wait until 2026 for some other cool planning items. One is a new above-the-line charitable deduction. And what do I mean by above the line? You do not have to worry about whether you itemize deductions or take the standard deduction. which folks usually have to consider when they're trying to optimize their giving strategy for tax deductions. So what this allows is folks to contribute either $1,000 if single, $2,000 if married filing jointly, to a qualified charity and deduct that right off the top of income. And anyone can do that, which is a very cool feature.
You know, I tell, as you know, I'm an analogy person. That's just how my brain thinks. But I tell people, I think of deductions as coupons. And so I tell them, it's triple coupon Wednesday at the IRS. We get to take your standard deduction, and then we have maybe some, the bonus deduction. Oh, wait, and we get this charitable deduction that we just get when we get to the register. We're just taking it right off of AGI. Would that be an accurate assessment of how we get to taxable income and how these deductions work?
It is. And there are fewer fetters, let's say, or limitations around this new charitable rule than there usually are with charitable deductions.
Do they have to prove up all the receipts and they can just take, or can they just take it as a standard deduction? Obviously, they need to be able to back it up if needed, or are they going to have to file in evidence of that they made the charitable contribution?
Yeah, good question. You typically don't have to attach a receipt when you send your tax return in. However, as the CPA, substantiation, documentation, always have it, always keep it.
You want to be there in case they do come in and ask about that. All right, so that's any other changes or big things coming for 2026 that you think listeners would want to know about?
Yes, certainly two more that are worth mentioning. One is the car interest deduction, so a personal vehicle. The interesting thing about this one is that personal interest expense, so think credit cards, for example, not usually deductible. Can't do anything with it, even if we pay it. However, for vehicles assembled in the United States, new vehicle purchase, you can actually deduct interest expense associated with financing on that vehicle up to $10,000 next year. There is an income limitation if you're a single filer and make over $100,000. That benefit starts to go away and phase out. But the ability to potentially deduct personal interest is something that doesn't come around very often.
And you mentioned that, and as I was reading through the bill, they couldn't just pick one income level. It was all over depending on what deduction. Some things kick in at $75,000, you start phase out, or $150,000, you married filing jointly. Other things it's $100,000, and so it was all that. So yeah, knowing the rules, that's where you come in and can really help listeners. All right, so we can charitable deductions above the line that we can take. We've got the ability to deduct auto loan interest for vehicles assembled in the U.S., so not necessarily U.S. automakers, but as long as they were assembled in the U.S. and purchased in 2025 or after. Is that correct?
Yes, I believe so. The deduction doesn't kick in until 26.
But 26.
Correct.
Okay. All right. Correct. And you mentioned maybe one more of the changes that comes in that was, I didn't mean to cut you off, but was there a third one?
Yes. The third thing that's worth talking about just a little bit is the introduction of a brand new tax-qualified savings vehicle called the Trump accounts. So there was actually guidance that the IRS issued within a week ago. So just a few days ago, they released some guidance on that. So the Trump accounts are for children born between 25 and 2028 that are U.S. citizens. And the government, this is one of the more famous parts of the provision, the government will fund $1,000 free pre-tax into these accounts established for these children. So the guidance that was released was a little bit more about the mechanics of you have to fill out a form, send it in, potentially attach it to your tax return that you're going to file in the spring to say, hey, I have a kid, please establish an account and put $1,000 in. And then on top of that, parents can contribute up to $5,000 per year, which is great. The coolest thing that I did want to mention that I had to read a little bit more and didn't realize until recently is that actually small businesses can use this as a fringe benefit for their employees. So small businesses can set up, and of that $5,000 per year that parents can contribute, small businesses can contribute $2,500 of that as just a benefit or part of a compensation package for employees. I thought that was pretty cool.
Yeah, these are something that we've never had before. So new, and as I understand it, reading, although it was introduced and created under the Tax Act signed in July of this year, 2025, it comes into effect July of 2026. So we can't open them prior to that. But it seemed to me in reading, any child under the age 18, it can be open for, right? If they were born 2025 through 2028, those are the only ones that qualify for the $3,000. But it can be open for any child under 18 at the time it's opened. Is that correct?
That's right, and that's a good clarification. So it qualifies for kids under 18, and then the actual account itself works like an IRA, a 529, or other kind of similar tax qualified accounts where you can access that money, and because it's a mix of pre-tax and post-tax when it comes in, it'll be a mix of taxable and non-taxable when it comes out. Generally, those funds are accessible once the beneficiary turns 18.
And anybody, including, as you said, employers can contribute some. A parent or guardian has to open it, but grandparents could make contributions. These count, but there is a limit of, you said, $5,000 per year that can be contributed to that. And it's not a tax deduction for the contributor. Like if grandma and grandpa put some money in an account, they don't get to take the deduction, but that portion of it would not be taxable to the children when taken out, but it's growing tax deferred. Did I understand that correctly?
Yes, that's exactly right. And then, as you mentioned, the 529s work the same way. The investments within the account grow tax-free, which is the big boon of using the vehicle.
Yeah, because as I read it, it's getting it once they turn 18, it becomes almost like an IRA, but it did seem to have some parameters. They could use it for certain expenses. I think there were some education expenses, maybe the first time purchase of a home or some things like that, a down payment. They could access this tax deferred account, but otherwise it becomes an IRA, and they just get this head start on this without having to have a JOB, right? Without having to have earned income, contributions can be made. So kind of a cool concept.
It is, I agree.
Any surprises in the tax bill that taxpayers need to be aware of that would be there that might catch them off guard or off surprise? Anything that was there?
Mm-hmm. Yes, a great question, and we already touched on it a little bit. The answer to that, in my opinion, would be the income limitation phase-outs. So all over these provisions, depending on the provision that you're looking at, if a taxpayer has enough other income or income is too high, the benefit sounds cool, but they actually don't end up qualifying for it, unfortunately. So car interest is one of those. There are a few others.
So one I've talked to clients about, because we've been hearing ever since 2016, and we're going to get into the historically low tax environment we're in, but since 2016, Roth conversions have become a very popular planning strategy because we're in this low tax environment. But it's not just about tax brackets, right? We got to watch tax brackets. We had to watch Medicare premiums, make sure we didn't get IRMA. And now we've got this thing of these phase outs, like, okay, well, if every dollar you convert's income, and now we're maybe pushing into phase out or those kind of things that come in. So yeah, just being aware of those limits. Let's talk about the tax bracket. So historical lows, at least from everything I can see going through the history of this, these are historically low tax brackets. 10%, 12%, then we jump 22, 24, 32, 35, 37. 2026, I think 12% up to for a married filing jointly, over $100,000 income at 12%. These are historical lows. I tell people I don't have a crystal ball. It's hard for me to imagine, though, it's going to get less than this, cheaper than this. I mean, these are historical lows. They are now permanent, meaning until Congress changes it, right? But there's no sunset provision this time. But how significant is it, these tax brackets we're in right now for taxpayers?
It's a great planning opportunity, certainly. So back in 2018, where we were first exposed to this set of brackets for the first time, I had completely different conversations with clients in 2017 than I did in 2018. Just because the benefits were so accessible to so many more people. So what that brings to planning now that we know what the rates are going to continue to be, I would say is stability. So we can continue the plans that we've set up for clients over the last 6 years in terms of managing tax brackets. So for example, in retirement, you might want to use traditional IRA funds to fill up to the top of a tax bracket, and then use Roth funds to supplement your income, whatever you need, on top of that to make sure you don't pay too much in tax or don't accidentally trip into a new tax bracket. That's a common strategy that we employ, and Roth conversions play into that as well. And now we know what we're dealing with going forward, which is good.
Yeah. Certainty is always good when it comes to planning, for sure. What I have seen, and I've seen a statistic on this, but and this was a goal of the Tax Act when it was passed the first go around under the Tax Cut and Jobs Act, TCJA, was to allow more people to just take the standard deduction, to simplify tax filing a bit. And the statistics I've seen range between 70 and 80% of all tax filers are now standard deduction filers. There's only between 20 and 30% that itemize. Has that been your experience of what you see within those statistics?
It very much has. And the plan is that will probably continue as a high percentage in the future. That'll dip a little bit because of the reintroduction partially of the state and local tax credit, which is a type of itemized deduction that went away in 2018. But thankfully for folks who live in states with income tax, thankfully that comes back as a deduction for a lot of folks.
Yeah, so let's get into that. So as I alluded to kind of at the outset here, there's some things for 2026 that seem to be coming in that are affecting itemizers that give them some benefit here. So maybe talk us through what are some of those big deductions that itemizers are, or might say, hey, maybe we want to itemize versus standard. And maybe even before you get into that, how does someone decide whether they're a standard deduction filer or if they're an itemizer?
Yes. So to set the table, we can either take the standard deduction or itemized deductions, and we take whichever one is the better deal every year. So we look at the standard deduction threshold for that year, which goes up a little bit with inflation every single year. This year, it's $31,500. So the question becomes, for a taxpayer, do all of our itemized deductions put together breach that $31,500 married filing joint limit? Single, it's $15,750. So the big itemized deduction buckets, there are really three of them. 1, mortgage interest, 2, real property taxes, and state and local income taxes, and 3, charitable deductions. So between those three areas, are we getting above the $31,500 limit?
Okay. Do medical expense deductions, would those also factor into that, and at what level would that go? So if somebody was going into nursing care, nursing home, would that be another bucket that they might consider, or how does that factor in?
Medical expense is another itemized deduction. I purposefully left that one out because most folks, and with exceptions, if it's the time where they're going into assisted living or incurring more medical expenses than usual, that is a deduction that's going to help them, or those types of taxpayers, on their annual filing. For most folks, the medical deduction is tough to actually see a benefit from because we can only write off or deduct medical expenses above 7.5% of income. So it's designed for folks in their working years to really not kick in unless you have a low income year and a high cost year for medical, which isn't ideal.
Right. Yeah, we don't want to be in taking that deduction and talking, Carlie, hey, I've got all these medical expenses, but yeah, nursing home care, something will come in, and and as an estate and elder law attorneys will often say, well, we wish we didn't have this, but now that we do, how can we use this with some tax planning? What buckets do we pay out of, et cetera? So okay, that's fantastic. I love that concept of thinking about it in the buckets. So mortgage interest, charitable deduction, And what was the third one that you gave was?
Yeah, I'll just say taxes.
Okay.
So a mix of state income tax and your property tax on your home.
Perfect. And we saw some increases there. What about small business owners? So what's in store under the tax bill for small business owners?
Yes, so a lot of different provisions depending on what kind of business that you run. Two items that apply to or could apply to pretty much any small business universally are, one, the return of 100% bonus depreciation. In layman's terms, that means if you buy a large asset that you would usually have to capitalize and depreciate over time, we can write it all off in year one. That is a nice planning tool to match, let's say, a big purchase of a vehicle, buy a new work truck, that kind of thing, match that purchase with a high income year. And so we can do that a little more effectively now that 100% bonus depreciation is back. It would have been or it was at 40%. So we could only write 40% of it off in year one, as an example.
So that's huge for business owners and definitely a planning strategy that I think would be there. Mm-hmm. We talked a little bit about the charitable giving strategies of the above the line deduction, but for those itemizers and people that are very charitably minded, anything that's changed there that would impact charitable giving?
There is. So a lot of sort of tweaks in the itemized deduction rules this year. So a advantage, of course, as we just talked about, was the additional ability to deduct state income taxes for the first time in a long time. Sounds great. However, on the other side, in a different area of itemizing rules, you have your charitable deduction, which actually has a little haircut on it. So if you donate to charity, we actually have to subtract 0.5% of income from that number, and then we can only deduct what's left. So there's a tiny little haircut or limitation on charitable giving that kicks in.
So you don't get to deduct the first 0.5 of 1% of your charitable giving if you do the itemizing.
That is correct. Now, don't let the tax tail wag the dog. Certainly, charitable giving should be about helping others. To get a nice little tax advantage from it is a nice boon. So don't let that 0.5% haircut stop your giving.
Okay. Anything else on the charitable giving you'd want your listeners to know about? Anything on that portion of it?
Well, to sort of bring that conversation and rule change to a close, 2025 is a year to kind of max out your charitable giving if you would like to, because there is no haircut in 2025. That haircut comes into place in 2026. So you're seeing a lot of donors, especially in the higher income tax brackets, you're seeing a lot of donors give more this year than they probably will in the future.
So those bunching strategies and that might make it more favorable this year. There's no, and by the time, unfortunately, we're at the very end of this year, Carlie. So by the time this gets out there to listeners, we may have missed the opportunity because we are here in December. But you're absolutely right that this is one of those things that I've talked to clients about maybe using those bunching strategies and that comes in. All right, so. Before I move, guys, I want to talk about you and your practice a little bit and transition there. But anything else from the tax bill for 2026 that you would want to make sure that we talk about here today or that you tell listeners about?
Yeah, well, so the opportunities are almost endless, no matter how much you make or what you do for a living. So we didn't even talk about the tip credit. We didn't talk about capital gains advantages for ranchers selling their land. So there's so much out there to take advantage of. And, certainly even for us, you don't know what you don't know. So that goes back to having a great team, having a great attorney and an accountant you can work with to go ask those questions of. Yeah,
we've seen an expansion on the child tax credit, ability to, I think, with thrift savings accounts and some flexible savings accounts so we can put money into expansion, I think, of the plans that qualify under HSA. So much that is packed into this bill, so much planning opportunity that can be, depending on someone's individual circumstances. And the idea is to figure out what is the best tax plan for you. Do we take standard deduction? Do we itemize? Whichever's greater that goes in. But working with people who understand the rules. There's a quote that I love. Judge Learned Hand. We read a lot of Judge Hand in law school. He wrote a lot of opinions that we spent some time reading. And one of the quotes I had, this was from a national tax controversy case that he was hearing. And his quote from that opinion was, there are two systems of taxation in America, one for the informed and one for the uninformed. And obviously there's not two systems of taxation, but what Judge Hand was saying is those who understand the rules and plan pay less in taxes than those who are uninformed and don't use the rules. And the tax, going through the tax code, it's complex. It's not fun reading. For most people, you enjoy this. This is what you do. And, sit around the fireplace and read tax code and at night. But, having a professional like you that's in the position to help make sure that they are using the rules to minimize the impact of taxes, short run as well as long run. And you do a great job for that. I said I wanted to transition, talk to you. Before I do, I do want to go back and just talk about some of the things for standard deduction filers. I think we've got time here today. So let's talk a little bit what was in store for this tax code. What did it bring to standard deduction filers?
Yes. So the above the line deductions, the car interest, and a few other things that we talked about that you don't have to itemize to get where you normally would have to itemize. But I'll go back to there are a few family-friendly provisions, such as the expanded child tax credit. It goes from $2,000 to $2,200 per child. There are expanded dependent care credit provisions, so you can get, usually it tops out, I think, at $1,200. I think you can go up to $1,500. So these are expenses like day camps, nannying, pre-K tuition, so you can get a nice little tax credit on top of that.
And there were definitely some things for tax filers 65 and older that got some benefits as well under the tax code, whether the itemizing or standard deduction, as I understand it. So I term it as the Social Security deduction. That's not exactly how it worked out, but that's been a big one that comes in. So maybe explain to listeners how that one works, or the $6,000 each deduction.
Yes, that's right. So, and this was part of the political negotiation process, but the Social Security deduction started as an intent to make all of Social Security non-taxable. Currently, Social Security is either a range of 0% taxable, depending on all of your other income, or up to 85% taxable. And so if you have supplemental pensions, 401k withdrawals, recurring taxable dividend, interest, and other investment income that you rely on in retirement for your annual budget, chances are your Social Security is 85% taxable. And so what this provision does is just allow a nice $6,000 extra deduction on top of your standard deduction which is intended to offset the taxable portion of your Social Security income. That one also, unfortunately, is temporary. That goes away after 2028, but let's use it while we can.
Yeah, it was one of those, as you said, through because the president was trying to push for Social Security to not be taxable. That's not the way it worked out. And what's interesting, I don't know what it's termed in the tax code, don't recall, but I term it the Social Security deduction, but you don't even have to be taking Social Security. It's triggered. You have to be 65 years of age, and then phase out $75,000 for a single filer, $150,000 for married filing jointly, and then you enter into phase out. Correct on those.
It is another provision where you have to watch how much more supplemental income you have on top of that, because for better or worse, the benefit of that deduction goes away after a certain level of income.
Yeah, and every dollar that's coming out of those traditional retirement accounts, those distributions, whether the forced, required minimum distributions or just additional distributions, voluntary distributions, all of that's income and can all of a sudden affect, like, oh, we lost some of these deductions because our income went too high, and oh, it affected our Medicare premium, and it pushed us into higher tax brackets. So back to why tax planning is so important. We need to be thinking through as we take income, where we take income from. All right, so I want to talk a little bit about you, and first of all, what does a great CPA client relationship look like? What would you want people to know when they're working with the CPA that makes your job easier and the relationship work better?
Yeah, great question, and thank you for asking. So we love proactive communication and really stress that in the relationships that we establish with new clients. So we have a structured approach that involves essentially pre-planning. So this December is a great time of year for really heavy lifting on the tax planning side, so that we don't have any surprises come spring or any unpleasant balances due that we didn't know about. So really being able to pre-plan and communicate with clients as early on as possible and throughout the year. So you'll be chatting with us, not just during preparation time in the spring. We want to chat with you all year and check in, see how things are going. How's the last quarter gone, if we chat on a quarterly basis? And based on that, do we need to increase estimated payments, decrease them? Are there any new strategies we can consider to help your tax efficiency? So we emphasize proactive communication when we can.
So always helpful there. What mistakes do you see taxpayers unintentionally maybe making that create problems at tax time?
Sure. Well, and I don't know if mistakes might be a harsh word, but what we have seen happen is taxpayers or clients that we work with might miss a tax document. And so we, collect the information, prepare the return, but that we might be missing, an income document, an investment 1099, a W-2 because they changed jobs. So we get that return filed and then get a year down the line and they get a matching notice from the IRS that says, hey, the IRS says we have this document with your Social Security number on it that we didn't see on your return, which, by the way, America is the only country that does that. All other countries in the world kind of pre-fill your tax return for you, and we're the only ones where if we miss a document, they come after us in a year, and we have to go fix it. So there are ways to check on that. We can pull transcripts from the IRS to make sure we include all of the documents on your return that were issued to your Social Security number. So we try to do that whenever possible.
What would be one thing you would want listeners to remember about preparing for the tax changes that have come in? Anything that would jump out at you you'd want them to remember?
Mm-hmm. Yes. I would say that because there are so many opportunities and so many limitations, just depending on your specific situation, there are a lot of good summaries online. There's a wealth of information out there about this bill. I would encourage anyone who hasn't yet to just do some reading on it. Find a good summary article, preferably from a well-known accounting firm or directly from the IRS, making sure it doesn't go through too many filters and you're getting good data. And then draw up a basket of questions and ask your accountant, hey, do I qualify for this? Is there any way we can plan to keep my income at a certain level where I might qualify for some of these provisions? Can I take the tip credit? Can I take the overtime deduction? Some of these provisions that are going to apply to some people, but not everybody.
And I would say, be careful with AI. I have had a couple clients who come in who have had some ideas of taxes and they've run some things through ChatGPT. Only have me tell them, like, no, that's pulling as if this new tax bill had not passed and we had sunset back to the prior one. I don't know what ChatGPT was doing, but it seemed to not catch that there was this tax bill passed, even though they had done these things recently. So yeah, reputable sources, and looking at multiple sources. I think that's great advice as I go out. you have your practice, so we've talked about tax preparation practice, but you also do the bookkeeping side, and you mentioned that in the introduction. So you work with a lot of businesses and doing the bookkeeping side of things. How's that different than tax preparation side?
Yes, so bookkeeping is higher touch, which can be a good thing for folks who need to look at their financials every month or every quarter and really use those to make smarter, more nimble business decisions. And that's part of our value offering by doing bookkeeping. So we'll zip up the books, customize a suite of reporting depending on the needs of the client, and sit down and have those planning meetings with them a little bit more frequently than the average tax client really needs. As well as, we need good data. So if we're doing a tax projection to see how much income, what the estimated tax calculation needs to be, or really doing any kind of tax planning at all, we need good data to make those decisions on.
Perfect. If listeners want to reach out and learn more about you or your services, what's the best way that they could connect with you?
Yes, the easiest way is to head out to our website, bittelbooks.com, BITTEL books.com. And the reason I say that is because we just had an overhaul and it looks really good right now. So check it out.
And I'll have to go. Yeah, I don't know if I've seen with the, I get on there frequently, but I don't know that I've seen the overhaul on here. So going in. All right. Anything else you would like to say before we wrap up?
Well, I not necessarily, but I really appreciate the invitation. I enjoy working with you, Glenn, and everyone have a great holiday.
Yeah, Carlie, you are just fantastic. I love working with you as well. And I am very happy to refer my clients your way because I know they're going to be taken care of and that they're doing someone who understands taxes and tax planning. And it always amazes me how responsive you are. I've sent you things on what I call the blackout dates when I know you are in heavy tax season. And I'm like, Carlie, I'm not expecting a reply. I just want to, while it's fresh in my mind, let me send something to you. And you always end up replying anyhow. So you are extremely responsive, proactive, and it's one of the reasons I love working with you and love giving referrals to you, and you do a fantastic job. So thank you for being here today and spending some time with us. And to our listeners, thank you for joining us. Our goal on this podcast is to bring you useful, relevant information that helps you make better informed decisions. You will find our podcast on Apple Podcasts, Spotify, YouTube. So look for us there, but you'll also find us on our website at stocktonlaw.com. So I'd encourage you to tune in for future episodes, but also go back and look at some of those past ones, and we hope that the information on here is relevant. So till next time, thank you for joining in and listening.
The information provided in this podcast is for general informational purposes only and does not constitute legal advice. Listening to this podcast does not create an attorney-client relationship. Laws vary by state, and this podcast focuses on estate planning and elder law in Kansas and Missouri. If you are located in Kansas or Missouri and require legal advice, please contact our office. Otherwise, consult a qualified attorney licensed in your jurisdiction.